Good morning. As the U.S. market is currently closed, let's look at exactly where Plug Power, ticker PLU, finished the session on Monday, October 20th, 2025. The stock closed at $3.40 per share. Now that $3.40 represents a 0.00% change from the previous close on Friday. But that flatline number is incredibly deceptive. It completely masks the battlefield that this stock was yesterday. The stock actually gapped up at the open to $3.63, spiked to $3.65, and then spent the entire rest of the day bleeding out, touching a low of $3.35 before a late-day bounce brought it back to that $3.40 close. This wasn't a calm day. It was a brutal tug-of-war on massive volume of over 112 million shares, and it tells you everything you need to know about the expectation versus the reality of this company. The immediate expectation, the one that has traders on their Robinhood app and SoFi Invest platforms hitting the buy button, is that Plug Power has finally turned a corner. The stock just went on an absolutely blistering run, jumping nearly 70% in the past month. We saw analysts at H.C. Wainwright slap a $7 price target on it, and just last week, TD Cowen raised their target to $4.50. The narrative is that the going concern risk is gone. The hydrogen economy is here, and this is the ground floor. The reality? That $3.40 closing price represents a stock that is gasping for air after a parabolic move, consolidating heavy gains, and facing a reality that is far more complicated than just a clean energy dream. The $370 million in cash the company just raised wasn't a sign of strength. It was an act of pure survival, executed through a complex warrant inducement that adds significant potential dilution down the line. Let's establish the common ground, because we all know the story. For years, Plug Power has been the ultimate hope stock. It's the poster child for the green hydrogen movement. Every investor looking for the next Tesla stock has at some point looked at Plug. The idea is simple. Plug is building the entire ecosystem. They provide the fuel cells, primarily for forklifts and warehouses for giants like Amazon and Walmart, and they're also building the infrastructure to produce and deliver the liquid hydrogen to power them. This is the online investment thesis you read about on forums, a vertically integrated clean energy giant in the making. Many long-term investors, perhaps holding in Fidelity or Interactive Brokers accounts, bought into this vision, believing it was a matter of when, not if. But the reality has always been the balance sheet. For just as long as Plug has sold the dream, it has been incinerating cash. This isn't a high-margin software business like Nvidia stock. It's a hard, capital-intensive manufacturing and logistics business. The company's cash burn has been legendary, leading to endless dilution, reverse splits, and late last year, a terrifying going concern warning, which is Wall Street speak for "we might go bankrupt." So when the stock suddenly rocketed from under $1.50 in mid-September to a 52-week high of $4.58 just last week, the expectation was that the company had solved its problems. The reality is that it just bought itself time. Let's break down the recent movement, because this is where the real story is. That massive surge wasn't just retail excitement. It was a perfect storm. First, you had the analyst upgrades, which got algorithms and momentum traders involved. Second, you had extremely high short interest. A lot of funds were betting this company would fail, and as the price rose, they were forced to buy back shares, creating a short squeeze. And third, and most importantly, was the news on October 8th. Plug announced it was raising $370 million. But how it raised it is critical. This wasn't a simple stock offering. It was a warrant inducement. In simple terms, they convinced an existing institutional investor either to exercise their old warrants, a right to buy stock at a set price, now by giving them new warrants to buy more stock in the future at a higher price of $7.75. This is the central tension. The expectation is, great, $370 million in the bank. The reality is, they got $370 million, but they had to essentially give away a massive new call option on their own stock to get it. This move, while necessary, creates a huge overhang of potential future shares. It was a lifeline, not a victory lap. And why did they need it so badly? Look at the second quarter 2025 earnings. Yes, revenue was up 21% year over year, which is good. But the gross margin was still negative 31%. Let me repeat that. For every dollar of product they sold, they lost 31 cents. Now, this is a massive improvement from the negative 92% margin a year prior, so the trend is heading in the right direction. But you cannot survive losing 30 cents on every dollar you make. The company is guiding for gross margin neutrality by the end of this year or early 2026, but that is an execution-heavy promise. That $370 million is the bridge to maybe get there. This is why yesterday's trading session was so violent. The 112 million shares traded weren't just retail investors doing some self-investing. That's institutional money. That's hedge funds that were short covering, momentum funds taking profit after a 70% run, and long-term believers in Fidelity mutual funds perhaps adding to their position, all fighting it out. The stock is now in a consolidation phase, trying to build a new base around this $3.40 level after its parabolic move. The bulls see this as a healthy pullback before the next leg up to $4.50 and $7. The bears see this as the smart money that rode the squeeze, now dumping their shares onto the retail crowd that just showed up. So, what exactly does this company do? It's broken into a few parts. The legacy business is GenDrive, the fuel cells for forklifts. This is their bread and butter, but it's low margin. The future, and the entire reason for the analyst excitement, is GenEco, their electrolyzer business. These are the big industrial-scale machines that use electricity to split water into hydrogen and oxygen. This is the picks and shovels play on the entire hydrogen economy. Plug has been announcing big deals for these, like a 2-gigawatt deal with Allied Green and delivering the first unit for a 100-megawatt project in Europe. This is where the growth is supposed to come from. If they can build these machines profitably and at scale, the whole picture changes. But there's an elephant in the room, and it's political. The entire bull case for green hydrogen in the United States is built on government support, specifically the 45V production tax credit. This credit is what makes expensive to produce green hydrogen competitive with cheaper gray hydrogen. The problem? The current administration has been openly hostile to clean energy spending, announcing billions of cuts to previously approved projects. We saw this earlier in the year when President Trump issued an executive order halting funding, which put Plug's other potential lifeline, a $1.66 billion loan guarantee from the Department of Energy, in serious jeopardy. While that loan hasn't been officially killed, the political environment is toxic for this industry. This is the existential risk. Plug could execute perfectly, get its margins to flat, and still fail if the government pulls the rug out from the entire industry. This is a far cry from the stability of owning Apple stock or broad Fidelity ETFs. This brings us to the future outlook and the tension between expectation and reality. The market's expectation is that the $370 million cash infusion is the all-clear signal. The reality is that it's just the starting gun for the real race. Can management deliver on its positive gross margins in the next 2 to 3 quarters? Can they do it while the political winds are blowing directly in their face? The company just named a new CEO, Jose Luis Crespo, to succeed Andy Marsh. This is another variable. Is he the operator who can finally get costs under control, or is this a last-ditch effort? If you are an investor, your strategy for this name has to be completely different from how you'd approach your core Fidelity wealth management portfolio or a robo-advisor like Schwab Intelligent Portfolios. This is not a buy it and forget it stock. This is a watch it every single day stock. Pro traders using interactive brokers trading platforms are looking at the chart and seeing a potential bull flag forming, but they're also watching the put-to-call ratio and the political news feeds like a hawk. A retail investor doing SoFi active investing needs to understand that this stock could just as easily go back to $1.50 as it could go to $5. The volatility is the entire point. It's a binary bet on execution and policy. Here's a question for everyone watching. Comment below with your average cost basis for Plug Power. I'm curious to